Hello students, today I'm going to discuss a very popular concept, liquidity trap. Liquidity trap is a very well-known concept and this concept was made very popular by John Maynard Keynes. Now for beginners, let us discuss the liquidity trap. In order to understand liquidity trap, we first need to understand what is liquidity. The liquidity in macroeconomic sense means the access of the funds over and above the supply in the financial market. In simple words, it means that our financial system, banks, NBFC, etc. have certain supply of funds, have certain supply of money. Similarly, the economy at any given point of time also has a demand for money. Now, the balance between demand and supply is called liquidity. If demand is more and supply is less, then liquidity is called tight or short. If demand is less compared to supply and lot more funds are available, then we call excess liquidity or surplus liquidity or easy liquidity. So that is how we generally talk about liquidity. Once now we have understood liquidity, let us talk about liquidity trap. Now, liquidity trap is a particular situation which arises in an economy after a certain crisis. Generally, when economy go into recession or crisis, the solution by the governments across the world is typically to reduce the interest rate. Why government reduce the interest rate? Because they believe reducing the interest rates make it attractive for people to take loans, and by taking loan they will create more demand, they will invest, and hence that will revive the economic activity. What happens in recession? In recession, economic activity goes down, slow down. People who were buying, people who were spending money, doing activity, who were producing, they slow down their activity. They believe in somewhat of a bad time, that time is not good for economic activity. Let us slow down a bit, let us stop for some time. And when good time will come, we will resume our activity. Generally, that is what common people believe, even those who are not directly affected. Okay, so that is what people believe in recession, and they cut down on economic activity. Government try to reduce that, and to reduce that, government try to encourage demand. There are two ways. One is fiscal policy, another is monetary policy. In the monetary policy option, government cut the interest rate, and by cutting the interest rate, the government believe that it will encourage the demand, investment and the economic activity, as I said earlier. Now, what is fiscal policy route? In the fiscal policy route, government spend money directly through government schemes, through different options, okay, through government policies, and by investing in infrastructure, by creating more roads, okay, more public parks, more public infrastructure, airports, railway lines, whatever government can think of, government try to do that in order to create more jobs and demand in the economy. Once government can create more demand in the economy, it will recover the economy from recession. So that is what all the governments across the world try to do. They opt for both monetary and fiscal policy, but there is a limitation of monetary policy, and that is liquidity trap. When government cut interest rate too much, then what happens? Liquidity is already in excess. Interest rates are already low. People are not creating enough demand. In this position, if government cut interest rate further, it is not going to create much of an impact. Let me repeat. Let us say interest rate was 7%. Government during the recession cuts it to 3%. Okay, but people do not take loan just because banks are giving it for cheap. If a bank person calls you or a bank salesman calls you and tells you, sir, please take a loan, our bank is giving at 6% interest, 5% interest, will you take a loan? If you have no need for money, if you have no plan to invest, or if you believe you are not going through a good time, okay, so all of that doesn't matter if people do not need money. Low interest helps when people need money. During recession, people cut on their need for money. Okay, so low interest rate doesn't encourage people to take loans too much. Some loans people do take, people who were planning to take loan, who postpone their decision due to bad time. Now they will see, okay, time may be bad, but interest rates are too good at present. So they may still take loan. So some people will take loan because of low interest, but a large number of people still do not take loan. Even if you cut down interest rate to very, very low. So in this situation, monetary policy is absolutely ineffective and monetary policy doesn't work. Interest rate becomes too low and further decrease in interest rate doesn't encourage economic activity. And this situation is called liquidity trap. That further increase in liquidity is not going to help in reviving the economic activity. And that way we say liquidity is now under a trap and monetary policy is now ineffective. And this is exactly what John Maynard Keynes argued. Okay, in his famous economic theory, he argued, general theory of employment, that monetary policy is ineffective post-recession because of liquidity trap. Hence, government should rely upon fiscal policy and should invest in infrastructure. That is exactly what he argued for. And this is where the concept of liquidity trap was used. I hope this concept is now clear, and with that many of the other things related to recession, government policy are also clear to you. Okay, in another video I will discuss more concepts like this, and I hope this video has helped you. And if you think this is helpful to you, it may also be helpful for your friends. So please do like the video, share the video, try to create maximum awareness about it. It's a new channel and it would be really helpful if you do so. Thank you.